Hi, I'm William Dolan, and this is Esquire Advice, where we explain complicated and lucrative real estate and business topics. Remember, we are not forming a lawyer-client relationship by way of this channel. Always consult your local attorney before taking any action. With that said, grab a pencil and a piece of paper and get ready to learn. Welcome to our beginner level episode on the 5 most popular strategies for investing in residential real estate. Before we get started, please kindly hit those like and subscribe buttons so we can keep bringing you valuable and profitable content. Now, let's dive in. The 5 strategies we will be covering are buying and holding, flipping, wholesaling, option deals, and lease purchasing. The first strategy, buying and holding, is where you purchase a residential property which commands a nice rent payment in comparison to its purchase price, and you rent it out to someone else. In this relationship, the owner of the property is called the landlord, and the person renting from the owner is called the tenant. Each state has a landlord-tenant code that creates special rules that landlords and tenants must follow. So as far as the advantages for this strategy, the first is monthly cash flow. You can make money each month from the tenant's rent payments. You can also pay down principal, or really use the tenant's money to pay down your principal. Most investors obtain mortgage financing to help purchase the property and use the money they receive from the tenant to make the mortgage payment. That means the tenant is paying down your mortgage balance and you are building equity as a result. The next benefit is appreciation. The value of real estate generally goes up over time. The fourth benefit is rental income is taxed at a lower effective tax rate. The IRS considers rental income to be passive income, and it is not subject to some of the same income taxes that earned income, like flipping and wholesaling, is. Depreciation is the fifth benefit. IRS lets you depreciate the value of the property over time, so you can create paper losses to offset some of the income that you've generated from your tenant. I know, appreciation and depreciation, both being benefits of the same strategy, seems a little strange, but I'm a lawyer, so what can I say? I can't help it. Now, when you sell the property, the IRS does recapture the depreciation benefit, but it is a great benefit while you own the property. So as far as the disadvantages for this strategy, the first is it's laborious. Managing rental properties can be time intensive. 2, they also take a lot of upfront cash. At a minimum, you will have to put down 10 to 20% of the purchase price plus closing costs, even if you get a traditional mortgage loan to purchase the property. You also have the risk of being sued. Tenants and their guests threaten to sue and actually do sue landlords all the time. This is just a fact of being a landlord, which is why you should always own each rental property in a separate LLC. All right, the next strategy we're going to talk about is flipping. This is where you purchase a residential property that needs some work at a significant discount. You renovate the property and resell it for a profit. This is where we start to get into the A to B, selling to B to C stuff, but I've saved that for the intermediate level episodes. For now, we're going to focus on the advantages, and the first advantage is more profit more quickly than buying and holding, at least. Most residential real estate investors target $15,000 to $50,000 in profit per property, and it usually takes 5 to 9 months from purchase to sale for them to make that profit. The next advantage is you do not have to manage tenant relationships because there are no tenant relationships. There are no tenants. The property is vacant while you're renovating it, and then you sell the property to someone who wants to live in it. With this strategy, there are disadvantages too. And the first disadvantage is it requires cash and a decent amount of cash up front. Generally, you have to put down not only the 10 to 20% of the purchase price plus closing costs, like the last strategy, but you also have to put up the renovation costs, even if you're getting a mortgage loan. However, there are some private lenders that can finance much more for you, but the interest rates and fees are generally a lot higher, which is going to eat into your profit. This strategy is also taxed at a higher income tax rate. Income from flips is taxed as earned income, so it's subject to the Social Security and Medicare tax, which is about 15.3%, in addition to still being taxed for federal, state, and local income tax purposes. And then number 3, last but not least, you have the risk of being sued here yet again. Contractor disputes and end buyer problems create the risk of lawsuits. That is why you should always own your flip properties in a separate LLC from your rental properties and other businesses. The third strategy we're talking about today is wholesaling. This strategy is where it starts to get complicated. But at a very high level, you find a good rental or flip property and enter into an agreement of sale to purchase that property. However, instead of closing and taking ownership of the property, you sell your rights under the agreement of sale to someone else, and that person closes and takes ownership of the property. This again is where the A to B, B to C thing is helpful, but we are keeping it super simple in this episode. To that end, the person from whom you purchase the property is called the seller. The person to whom you sell the property is called the end buyer, and you are called the wholesaler. The advantages of this strategy is that wholesaling does not require much cash as long as everything goes well. Since you do not close on the property and take ownership of the property, the only money you need, again, as long as everything goes well, is the initial deposit that you will give when you enter into the agreement of sale. Oftentimes, real estate investors will only put down $10 or $100 for this deposit, which is not much money at all. Therefore, the next benefit is it's an incredible return on investment. On the low end, some real estate investors make $1,500 to $2,500 per property, but others target higher margin deals and make $25,000 to $75,000 per property. In any case, based on an upfront cost of $10 to $100, that makes one heck of a return on investment. As for the disadvantages, wholesale deals are more complicated because there are quite a few more moving pieces, and there are also some unique restrictions and complications that arise on them. Secondly, there's a higher tax rate. Wholesaling is taxed as earned income also, which has the higher effective tax rate. This is the Social Security and Medicare tax again, which is about 15.3%, in addition to the federal, state, and local income tax that you're going to have to pay. There's also a possible regulatory issue here because this activity is so similar to what a real estate agent does, and real estate agents are required to obtain professional licenses. If done properly, wholesaling is okay in some jurisdictions, but if not done properly, it is not okay. Also, importantly, there are some jurisdictions where it is going to be a problem no matter how you do it. The fourth strategy we're discussing today are option deals. This one is a bit more complicated too. On an option deal, you will enter into an option agreement with a seller, which gives you a right, but not the obligation to purchase a property for a certain period of time. You can then sell your option to someone else for a profit, or pool the money together and purchase the property yourself. The advantages of this strategy is that it doesn't require much cash initially. You will need to pay the seller some money to tie up the property, but that may be in the $1,000 to $10,000 range, depending on the value of the property, the purchase price you negotiated, and the length of the option period. You also get to control the property. You control it for at least for as long as your option is valid. There are disadvantages too. It is harder to get homeowners to agree. Generally, homeowners are reluctant to tie up their property, even with the prospect of being paid money to do so. It is also challenging to get them to understand how an option works, which means you really need to understand it very well to overcome that hurdle. Depending on what your plans are, there could be regulatory issues here too. Just as with wholesaling, if you plan to sell your rights under the option agreement, this activity could be viewed as similar to what a real estate agent does, which again, real estate agents are required to have professional licenses. If you are holding the option for yourself and not selling to someone else, it's okay. But if you try to sell it, that could be a problem in some jurisdictions. The fifth and final strategy we're going to discuss in this episode is lease purchasing. This is probably the most complicated of the strategies we are discussing. Lease purchasing is essentially where the seller finances the purchase of the seller's property. But you do not take title ownership until you've paid the total purchase price and the applicable interest. It is sometimes referred to as a lease purchase transaction, but it is also referred to as a contract for deed, agreement for deed, or an installment land sale contract in some areas. The advantage is less cash to purchase the property. You will negotiate for the seller to finance most or all of the purchase price, so you will have a small or possibly even no down payment. Also, you will not need to pay closing costs now because you are not taking title ownership now. You're taking it when you've paid the seller in full. The seller is also financing. That means there's no lender. Since the seller is financing, generally loan approval is easier and loan terms are more favorable. As for disadvantages, many states have complicated statutes that govern this kind of deal, meaning you will need a local lawyer to convert whatever terms you and the seller agree to into something that works under the applicable statute in your state. Also, these deals are more complicated to explain to a seller. These deals are harder for sellers to understand because there is a seller financing component, but not an immediate sale. When you add in a complicated statute, that revs up the complexity significantly and makes it tricky to get sellers comfortable with this strategy, which again is why you need to have a tremendous command of how this strategy works in order to use it. Watch our intermediate and advanced episodes on this topic for more help. The final issue we're going to discuss is title. Is title clear? There are two discrete but related issues here. One is whether title to the property is clear at the time you enter into the lease purchase agreement. And the second is making sure it remains clear from the time you enter into the lease purchase agreement until record ownership is transferred to you. Both can be covered for the most part, but you will need to roll up your sleeves to do so. So, in summary, the 5 most popular strategies for investing in residential real estate are buying and holding, flipping, wholesaling, option deals, and lease purchasing. If you are interested in more advanced material, we have intermediate and advanced level episodes for each of these 5 strategies, plus many, many other topics. Again, kindly hit those like and subscribe buttons so we can continue to give you more great content, and hit the notification bell if you want to know from YouTube the next time we upload a video. With that said, thanks for watching, and I'll see you next time.